Oscar Health just reported the kind of blockbuster quarter that usually sends a stock into the stratosphere. I mean, we're talking a massive top and bottom line earnings beat. The company absolutely shattered Wall Street expectations, swinging from deep historic losses to record profitability. And yet, on the exact same day, the stock fell off a cliff.
That is the central mystery we are unraveling in today's explainer. How can a company post phenomenal, undisputed financial improvements, yet see its valuation instantly slashed? To understand the tension here, we have to look at the massive disconnect between what the headline numbers showed and the terrifying structural gravity the market sees hiding just under the surface. Just look at the sheer scale of this Q2 2026 earnings beat. The headline evidence was spectacular. Wall Street was looking for an earnings per share of about 40 cents. Oscar Health delivered a massive $1.10. At the same time, they drove total revenue up an astounding 70.4% year over year, hitting $4.88 billion for the quarter. In the capital-intensive world of health insurance, growth numbers like that are almost unheard of. But instead of a rally, the market's reaction was totally visceral. Oscar Health shares plummeted by 11.86% on heavy trading volume the very day of the announcement, dropping to $26.54. It is a stunning paradox. To understand why Wall Street chose to punish a record-breaking quarter, we first need to understand the economic engine driving this business and what exactly broke the market's trust on August 6th. Section 1. The Tech-Powered Health Engine.
So Oscar Health is not your traditional legacy insurance underwriter. They operate as a tech-powered managed care organization, primarily serving the individual health insurance marketplace under the Affordable Care Act, the ACA. They're also rapidly expanding into what are called ICHRA solutions, which is basically a way for small and mid-sized employers to give their workers tax-free dollars to go buy their own health insurance on the individual market, rather than the company buying a massive, expensive group plan. What separates Oscar from the pack is its underlying architecture. The real economic engine here isn't just selling premiums, it's operational leverage. And this brilliantly illustrates their moat, Oswell AI. This is Oscar's proprietary care navigation agent. It actively steers members toward high-value, lower-cost clinical settings. Get this, in early radiology pilots, 25% of members actually followed Oswell's clinical routing recommendations. The result? An average savings of $75 per appointment. When you scale that across millions of members, you are looking at serious margin expansion.
Notice the architectural contrast here. Legacy managed care peers, like United Healthcare or Centene, are managing highly fragmented systems. They've inherited a mess of different databases from decades of mergers and acquisitions. Oscar, on the other hand, operates a single, unified, full-stack data platform. This structural uniformity allows them to deploy AI at scale, hitting a 98.7% first-pass accuracy rate on automated claims processing, with most reviews done in under 48 hours. They process information faster, cheaper, and more accurately than the giants. But here is where the foundation gets a little wobbly. Look at how they actually get paid. If you look at their premium revenue for the fiscal year ending December 2025, 93% of it was funded directly by the federal government through advanced premium tax credits, or APTCs. Only 7% was paid directly out of the pockets of the individual members. This extreme reliance on government subsidies creates incredible visibility when times are good, but it sets up a massive existential vulnerability to federal policy changes.
Section 2. The Q2 Earnings Evidence.
Let's look at the evidence and see how this builds into the Q2 2026 financial turnaround. Because on paper, this quarter looked like the moment Oscar finally proved its tech-driven thesis to the world. Just look at this monumental swing. In Q2 2025, Oscar reported a GAAP loss of 89 cents per share. Exactly 1 year later, they post a profit of $1.10 per share. This was driven by ruthless pricing discipline. They implemented a roughly 28% weighted average premium rate increase for the 2026 plan year, which effectively outpaced underlying medical cost inflation. As a result, their medical loss ratio, that's the core metric showing what percentage of premiums are actually paid out as medical claims, improved by a staggering 1,190 basis points year over year to 79.2%. And remember that unified tech stack we talked about earlier? Here's the proof that it's actually working at scale. Oscar's SG&A expense ratio plummeted to a record low 14.2%. That's a 450 basis point improvement from the prior year. The company's processing 46% more members, reaching nearly 3 million effectuated lives, while significantly lowering their administrative overhead. This gave management the confidence to raise their full-year earnings from operations guidance to a midpoint of $600 million. And by the way, If you like deep evidence-based stock breakdowns like this, make sure you're subscribed. When we synthesize all of this into a qualitative scorecard, Oscar Health scores a 6.5 out of 10. Management alignment is a strong 8 out of 10. CEO Mark Bertolini and the founders have substantial skin in the game, and their recent share sales were strictly non-discretionary tax transactions. Their market position is also an 8 out of 10. They've expanded their active footprint market share from 17% in 2025 to 30% in 2026. But the anchor dragging this whole score down, revenue quality. It's sitting at a 5 out of 10. That 93% reliance on government subsidies creates intense concentration risk.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at Flash.StockSentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch to monitor your portfolio for important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flashstocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 3, the hidden market risks.
Okay, so let's pivot back to that central conflict. We have record growth, record profits, expanding margins. So why did the stock crash 11.86%? Because institutional investors read past the headline numbers. They dug into the footnotes and the forward guidance, and they found 3 distinct hidden risks that absolutely spooked them. The first major red flag was the quality of the earnings beat. The market realized that Oscar's $361.8 million in Q2 net income was heavily distorted by a massive one-time benefit. The company recognized $164 million of favorable prior period reserve development during the quarter. This was essentially a positive true-up following the final 2025 CMS risk adjustment report. Great news for this quarter, sure, but it's completely non-recurring. Without that one-time $164 million injection, the underlying operational beat looked much more modest, making investors really question the true sustainability of these new margins. The second concern hit right at the core of their growth narrative. Management disclosed that in the second half of 2026, they expect to see accelerated membership churn. Historically, monthly churn runs around 1% to 2%. But due to intense new CMS eligibility verifications and program integrity reviews, management guided for monthly churn to spike to between 2% and 4%. Losing members at double the normal rate heading into the back half of the year, that completely disrupted the market's forward revenue models. But the ultimate existential threat, the real reason the market is terrified, is the ARPA subsidy cliff. Enhanced premium subsidies, originally established under the American Rescue Plan Act, expired and reverted to pre-ARPA levels on January 1, 2026. This caused a sharp rise in premium costs for middle-income enrollees, driving a massive 12% contraction in the total ACA individual market. The fear here is a classic adverse selection death spiral. As prices go up, healthy price-sensitive members drop their coverage, while sicker, high-utilizing enrollees stay. This concentrates the risk pool, drives medical costs through the roof, and could completely wipe out Oscar's hard-won operating profitability heading into 2027. Section 4, the 5-year scenarios. Before we break down the math here, I need to explicitly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios. We have modeled 3 starkly divergent 5-year valuation outcomes from 2026 out to 2031. With the stock trading around $26.54 after the post-earnings crash, the dispersion of these outcomes is massive. We're looking at a downside of $14.78 in the low case and an upside approaching $100 a share in the high case. The difference entirely comes down to 3 things: operating margins, revenue scale, and the valuation multiples the market is willing to assign to a heavily regulated underwriter versus a high-margin tech platform. In our base case, the core individual ACA market stabilizes after this initial post-subsidy shock. Revenue grows at a moderate 10% compound annual rate over 5 years, reaching $30.36 billion. This is supported by steady employer adoption of the ICHRA model.
Underwriting discipline and AI-driven savings from the Oswell platform push operating margins to a healthy 4.5%. Slap a standard managed care PE multiple of 15x on that, and the implied future share price lands at $50.38, representing an annualized return of roughly 13.6%. But the high case is where Oscar's technology optionality really shines. This scenario assumes aggressive adoption of defined contribution benefits, with employers rushing to ICHRA plans. Crucially, Oscar successfully scales its Plus Oscar enterprise software licensing and dominates the ICHRA's data exchange. Revenue hits nearly $38 billion. Because software revenues don't carry insurance underwriting risk, operating margins expand to 6%. The market rewards this transition from capital-intensive insurer to tech-enabled platform with a premium 18x PE multiple. The implied share price rockets to $99.25, delivering an annualized return of over 30%. Now we must respect the low case. Here, the subsidy cliff triggers severe compounding adverse selection. Healthy members flee, medical inflation outpaces rate increases, and Oscar is forced to exit unprofitable counties. Revenue growth stalls out, reaching just $22.9 billion in year 5. Margins collapse to 2.5%. The market treats the company as a highly risky, purely regulated underwriter, assigning a dismal 10x multiple. In this scenario, the stock is dragged down to $14.78, burning significant shareholder capital. If you want to dive into the exact line-by-line math and the probability weights driving these cases, you can access the full model in the free research report at Flash. So, what should you actually be watching next? The market is going to be hyper-focused on concrete early warning signs over the next few quarters. Specifically, investors must monitor the monthly wakely morbidity data. If this shows the risk pool deteriorating and getting sicker, the adverse selection thesis is coming true. You also need to watch that sequential membership churn. If it consistently breaches that 4% upper limit during the second half of 2026, the revenue foundation is actively cracking.
And this ultimately resolves the mystery of August 6th. The market didn't punish Oscar Health because the Q2 execution was bad. They punished it because they literally don't know if the company can survive the environment it's about to enter. Oscar Health is a brilliantly executing tech-forward turnaround story that is currently staring down the barrel of a structural regulatory cliff. The stock dropped because Wall Street is weighing incredible present operational execution against terrifying future policy gravity. The tension between these two forces will dictate the next 5 years of this company's life. But it leaves us with one critical question. If an insurance company successfully builds the AI brain of the future, will regulatory gravity even let them use it? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.